Good morning, everybody. Good morning, everybody, and happy Thursday, everybody. Today is February 6th, 2025. The top story this morning is the Bank of England, what they're saying, what they're not saying, and what they're doing with their forecasts. And it really is a testament to just how awful central bankers are and how bad they are at their job. And I tell you, man, like even weathermen are impressed on how often central bankers can get everything wrong and still maintain their position, still keep their job. I mean, think about it. These inflation targets, all these central bankers around the world, they tell us all the time how acutely aware of the hardship and the pain inflation causes is. And we're just normal people like you, even though we haven't done our own food shopping in 25 years. We feel your pain, and people believe this garbage. And yet they're never held to account for just how bad they are at their job. Case in point this morning is the Bank of England. The Bank of England just cut rates 25 basis points. That's their third rate cut since August of last year. They voted 5-7 in favor of this 25 basis point cut. The two votes that were dissenting actually wanted 50 basis points of cuts. So the debate was over cutting more, not cutting less. Right. So there's your dovish monetary tilt, more easy money. We're very rapidly returning to Zerpenber, even though they never once hit their inflation target. Remember the arbitrary 2% target? I mean, we haven't hit that in 3.5 years now. And yet everybody's like, oh, don't worry. Any day now, we're going to get it. But that's not the thing. The thing is they cut rates, but they raised their inflation forecast. And they didn't just raise their inflation forecast a little bit, guys. They raised it a lot of bit. Their guidance for inflation was increased from 2.8% to 3.7%. I mean, they increased it by a third, 90 basis point increase in what they expect inflation. But don't worry, they told us expect it to be temporary. I kid you not. Inflation will be temporary. Have we heard this before? It sounds, where have we heard this before besides 2020, 2021? And oh, that's right. Remember transitory? Did they just drop another transitory on us? I think they did. So they're cutting interest rates for the third time while raising inflation forecasts. Make no mistake, guys, these central bankers, every single time they will opt on the side of inflation versus the side of anything that might threaten asset prices. Every single time. And that's why, I get a lot of comments from people saying they're expecting a deflationary crash and, we need more and more easy money to feed the system. And the second they stop, it all breaks. I agree with all of that. I agree with the sentiment, and I agree with the economic principle behind that. But the factor that all these people are missing is that central bankers will opt to ease instantly. The moment any of that shows up, they will instantly return to easing, no matter how much inflationary pain it causes. They do it every single time. Look how quick it happened in March of 2023 when the banks started failing. By the way, guys, my voice is still a little coarse. I'm on day 4 of this wonderful little whatever the heck it is I got going on here. The latest and greatest innovation from the Wuhan Institute of Technology, if you will. Anyways, on top of that, speaking of the BOE, they lowered rates. They raised their inflation forecast. Oh, and they cut in half their forecast for economic growth. Well, isn't that fun? You got your inflation and now you got your stag. Economic growth is decided they lowered it from 1.5% to 0.75%. So now we got lower economic growth. We got rising costs, rising inflation, and more easy money coming. Stagflation. The Keynesian economist tells us it's not supposed to be possible. We're not supposed to have lower economic growth and rising inflation at the same time. My Phillips curve says that's impossible. Well, the time to throw out your Phillips curve was more than 50 years ago. It does not work. So that's the lovely gift we get from the Bank of England this morning. We got a lot of earnings this morning. We had Ford reported earnings yesterday. Fourth quarter sales were actually up 2% year over year. That wasn't so bad. They posted a loss of $5 to $5.5 billion, or they're forecasting a loss of $5 to $5.5 billion on EVs for 2025. But it was their much weaker forecast for 2025, adjusted profits that really sent Ford shares down hard here. The stock is selling off about 4.5% this morning. Look, we know tariffs are going to take a chunk out of Ford. We know the auto industry is in trouble. We know the auto finance industry is in trouble. They're cutting production in a lot of these vehicle factories. The problem in the auto industry, it's a lot like the problem in the housing industry. The problem is we don't need to cut production. The problem, we don't need to change all these labor contracts and everything. What we need is cheaper cars. They need to stop cramming so much crap into the cars to make what used to be an affordable sedan a $60,000 computer that breaks down every 3 months. Whatever happened to the base model vehicle that gets you from A to B? You cannot find it anywhere in the United States anymore. That's what the vehicle industry needs. They won't give it to us. They just keep giving us more computerized crap. And so Ford is cutting production, cutting their forecast, and the stock is suffering from it. Speaking of computerized crap, we got a good quarter from Peloton. And I use that term lightly, a good quarter from Peloton. What does that look like? A net loss of $92 million. But when you compare it to Peloton's last quarter or a year ago, they lost $195 million. Well, yeah, okay, it does look good. Only Peloton looks good next to Peloton other quarters. Net sales were down 9%. Hardware sales were down 21%. But it seems Peloton is finally getting a handle on their costs, which have been out of control. They brought those down substantially, hence the much smaller loss for the quarter. Peloton shares are actually rallying double digits on this news. Go figure, you post a $95 million or $92 million loss and your stock is up double digits. We also got earnings from ConocoPhillips this morning. Net income was down on lower energy prices. No surprises there. They did forecast a pretty big increase in production for 2025. ConocoPhillips says a lot of new oil supply is going to be coming online next year, so that's interesting. They're also increasing their share buybacks and dividends, so more money returning to investors there. There's another one of these stories in TechCrunch this morning. Shout out to my moderator, Mish, found this one. Really good story about another one of these distills, one of these AI models. Researchers at Stanford trained this AI model based on DeepSync and something to do with Alibaba's Quen model or Queen model. I don't know how you pronounce it. But here's the thing. They trained this AI model for $50. $50 worth of compute credits was all it cost. Now, we're seeing a lot of these stories. These things are called distills, where they download the bare bones AI model from one of these, large language models, whether it's DeepSeek or Google or ChatGPT. They teach it to do one thing really well. They distill it down, and then they train the thing for very little money. And then at that point, you don't need a data center anymore. You can run the thing just on local hardware. Now, admittedly, guys, I'm a mechanical guy. I don't know a lot of software programming, but I'm seeing more and more stories of like low double-digit dollars, not double-digit billions, double-digit dollars, $30, $50 to train these AI distills that for 95% of the applications most people would ever use them for, it's good enough. So I got to wonder, where is the reckoning in AI data center? Why are these big tech companies still pumping tens of billions, hundreds of billions in CapEx into building out new data centers when it is becoming increasingly obvious that this space is now so heavily commoditized that there's not going to be a market for those data centers? It seems to be a reckoning that this market is avoiding like the plague. Once again, the floor is price discovery. Everybody get off the floor. We also got some labor data this morning. Challenger job cuts came out. 49,795 jobs were eliminated in the month of January. Now, that might sound bad, but that's actually down about 40% versus January of last year. It's something I've been noticing, guys. The pace of layoffs is way, way down versus a year ago. Now, we got the JOLTS report earlier this week that showed the pace of hiring is also way down. But when it comes to tomorrow's non-farm payrolls, this is very hard to handicap because we're seeing job losses are slowing, but job creation is also slowing. So it's getting harder and harder to really forecast what's going on in the labor market as things are just slowing down. It's a lot like the housing market. The prices aren't really moving, but the number of sales aren't really moving either. We got initial jobless claims, 219,000. That's up slightly from 208,000 last week. And continuing claims, 1,886,000. That's up about 36,000 from last week. So a little bit of weakness in the labor market here. Nothing too terrible. Again, it's a really tough call for that jobs number tomorrow. We'll just have to wait and see until tomorrow morning when that non-farm payrolls report comes out. We're going to go pretty fast again, guys, today because you can probably hear it in my throat. We're just not doing so hot over here. Let's shrink my big melon of head and see what's going on in the market. Don't forget that like button and that subscribe button for the YouTube algorithm, because I promise you one day my normal voice shall return. And well, you're just going to want to be here for that when that happens. The S&P 500 is up 15 points, 0.26% higher, a little bit of green this morning for stocks. The Dow, meanwhile, is up 83 points or 0.18% higher. And the NASDAQ is barely positive here, up 3 points or 0.01% higher. Not a lot happening in stocks this morning. Switching over to the U.S. dollar, we are below 108, 107.95. That's down by about 33 basis points this morning. Looking over at the bond market, we have got yields are up across the board. 30-year Treasury, 4.643. That is up a fraction of a point. The 10-year, 4.440. That's up 2 points. The 2 years at 4.212, up almost 3 points. And the 1 month is at 4.304, unchanged. Looking over at the commodities board, it looks like gold and silver are taking a break this morning. Spot gold is actually down $12.12 here, 2,855 after touching another all-time high yesterday. We're off by about 0.4% this morning. Spot silver, meanwhile, $32.04. That's down about 27 cents or 0.83% lower. I like the shiny. Meanwhile, we've got copper's up by about 1/3%. Platinum is down by 1/3%. Palladium is off by 1.5%. And West Texas Intermediate crude oil is up 1% at $71.73 for March futures. That's up by about 70 cents. Looking over at Bitcoin, we're holding here around $98,321. It's priced on Coinbase, roughly where we were yesterday. I just want to point out here, Bitcoin is now 2 days in a row. We have been stuck below the 50-day moving average. We've made several attempts to recapture that level, and we have failed to hold it. So it looks like a technical breakdown may be in progress for Bitcoin here. Keep an eye on that 98,750 level, roughly. That's about where the 50-day moving average is. All right, let's talk about the Bank of England, my favorite demographic to bash. Central bankers, they are the worst of the worst. Bank of England cuts rates, sees higher inflation and weaker growth. That Keynesian, what do we say? The unicorn, it's not supposed to be able to happen. We're not supposed to have high inflation and weak growth at the same time. Mr. Phillips said it can't happen. Well, there it is at the Bank of England. The BOE lowered interest rates by 1/4 percentage point on Thursday, judging a sharp upward revision to its inflation forecast for this year will prove temporary. Oh boy, they just dropped the transitory on us. Yep, they sure did. While two officials called for a bigger rate cut against a backdrop of weaker growth. The cut to 4.5% was in line with economists' expectations in a Reuters poll, but the two dissenting votes from external members, Catherine Mann and Swati Dhingra, hope I said that right, in favor of a bigger rate cut to 4.25 were not. Now, let's scroll down a little bit here. Inflation, already above target at 2.5%, is expected to peak around 3.7% in the third quarter of this year due to higher energy prices and expected increases in regulated water bills and bus fares, up from a previous forecast peak of 2.8%. Now, guys, we're at 2.5. The previous peak they told us was 2.8, and now they're raising it to 3.7. That is not a trifle sum. They are raising their inflation forecast by a lot, and they're saying, don't worry, it's only going to be temporary, as if 2020 never happened. You got to love these people. They are truly shameless. The BOE does not expect inflation to fall back to its 2% target until the final quarter of 2027, 6 months later than it had forecast before. Now, guys, I want you to imagine your boss. I want you to imagine the owner of the company you work for. I want you to imagine it's your annual review time, and you have not hit your monthly goal in 3.5 years. and you go in at your annual review and you tell your boss, don't worry, by the end of 2027, all right, almost 3 years from now, I might hit one of my monthly goals. You think you'll still have a job? If you're a central banker, then the answer to that question is a resounding yes, apparently, because there's nothing these guys can do that would cost them to lose to their job. They're unelected bureaucrats. Must be nice. The central bank also halved its forecast for growth this year to 0.75%, reflecting weak business and consumer sentiment and more sluggish productivity growth, although forecasts for annual growth in 2026 and 2027 were revised fractionally higher to 1.5% and from 1.25%. So just how bad are they at their job? Number one, they're going to go 5-6 years without hitting their target. But hey, at the same time, their other side of their mandate, their maximum employment, their economic prosperity, nope, we're not going to hit that either. We're cutting our forecast for economic growth in half as well. So, I mean, it's just really bad showing by the Bank of England here this morning. And, is it any wonder that Bitcoin is hovering near all-time highs, that gold is hovering near all-time highs, that silver is near, about a 12-year high? It's not a coincidence, guys. The central bankers are not done messing up the world. They really aren't. All right, let's get into some of these earnings. We're going to go fast here. Ford's weak guidance sends automaker stocks sliding. Ford relentlessly focused on cost, their incoming CFO says. Prove it when we'll get to your EV division. Let's see. Ford Motor Company shares dropped 4.5% in after-hours trading Wednesday after the automaker hit a quarterly sales record, but raised the alarm with light guidance for the year, saying profits will be marred by headwinds related to market factors. Ford called for 2025 adjusted profit before interest and taxes of between $7 billion and $8.5 billion, which would be down from last year's adjusted earnings before interest and taxes of $10.2 billion. That's way down from last year. It would also be weaker than Wall Street's consensus for $8.3 billion. So Ford, that forecast just killed Ford here. They also called for a $5 billion to $5.5 billion annual loss on its EV unit after the unit lost $5.1 billion last year. So even though they're relentlessly focused on cutting costs, they're forecasting an even bigger loss in their EV division for 2025. So how's that relentless focus going over there? House said that the company was able to increase volumes and continues to invest in next generation electric vehicles. Doesn't sound like a relentless focus to me, but okay. Ford sales for the fourth quarter clocked in at $48.3 billion. That's a 2% increase over the fourth quarter of 2023. The automaker earned an adjusted 39 cents a share in the quarter, up from 29 cents a share in the year ago period. And let's look at what Ford shares are doing here at $9.47. Ford is off by 5.4% this morning, down 54 cents. So it's rough break for Ford shareholders here. The cash burn in the EV division is just killing this company. Now, shares of Peloton surged by 13% as it edges closer to profitability and posts better than expected results. And I do use that term lightly. Peloton told investors Thursday it still had a steep hill to climb to achieve profitable growth under its new CEO, but the connected fitness company beat holiday sales expectations thanks in part to its partnership with Costco. The bike maker posted mixed fiscal second quarter results as it topped Wall Street sales estimates, but lost more than expected as it continued its efforts to make its costly hardware business more profitable. And I don't want to say more profitable here. That's the wrong choice of words. How about profitable at all? I mean, you got to love the way CNBC puts a positive spin on everything. Yeah, we haven't been profitable in years or like ever, and we're trying to make it even more profitable. Well, yeah, slightly more than zero, I guess. The company's reported net loss for the 3-month period that ended December 31st was $92 million or 24 cents a share, compared with a loss of $195 million or 54 cents a share a year earlier. So yes, that is more profitable, but still a huge loss. Sales dropped to $674 million. That's down 9% from $744 million a year earlier. Peloton's holiday quarter is typically its strongest for hardware sales, but most of its revenue decline came from that side of the business as sales fell about 21%. Now, all those results apparently are being interpreted as bullish for Peloton because the stock is up 17% pre-market here. trading at $8.88, up $1.30. It's that reduced cash burn, a narrower loss, down, significantly from what the loss was a year ago, but still a loss. This company is a long way from profitable here, folks. All right, now we got Conoco's quarterly net income fell, but they expect 2025 production growth. The oil giant signaled more aggressive dividend and share buyback campaign. ConocoPhillips said fourth quarter net income declined alongside energy prices, but the oil giant forecast production growth in 2025 while signaling a more aggressive dividend and share buyback campaign following the recent closure of its multi-billion-dollar Marathon Oil acquisition. For both the first quarter and year as a whole, Conoco projected production of 2.34 million to 2.38 million barrels of oil equivalent a day, compared with 1.987 million barrels of oil equivalent a day in 2024. So Conoco's forecasting a big jump in production here. Now, it looks like this is an organic increase, and they're not just tacking on the Marathon Oil acquisition there. I could be wrong about that, but it looks like this is just increases in production here. Conoco's forecast capital expenditure of about $12.9 billion for 2025, and the company said it returned $9.1 billion to shareholders in 2024, anticipates returning more than $10 billion this year. So there's that increase in share buybacks and also dividends. Conoco stock, though, kind of not moving here, down about 0.25%, $99.97. That's off by about a quarter. Now, this is an interesting one that my moderator Mish found this morning. Researchers create an open rival to OpenAI's 0-1 reasoning model for under $50. Now, I'm seeing a lot of stories like this recently, guys. A lot of them. I saw one as low as $30, this one for $50. And the important thing to keep in mind here is these are distills, all right? These are like they're carbon copies and they're shrunken versions of these large language models that only do one task but do it really well. But the point is how cheap these things are. That's what you got to realize here. AI researchers at Stanford and the University of Washington were able to train an AI reasoning model for under $50 in cloud compute credits, according to a new research paper released last Friday. There is no typo there, guys. It's not under 50 billion. It's not under 50 million. It is under $50. 50. That's how much it cost them to train this AI model. The model, known as S1, performs similarly to cutting-edge reasoning models such as OpenAI's O1 and DeepSeek's R1 on tests measuring math and coding abilities. The S1 model is available on GitHub along with the data and the code used to train it. The team behind S1 said they started with an off-the-shelf base model, then fine-tuned it through distillation, a process to extract the reasoning capabilities from another AI model by training on its answers. The researchers said S1 is distilled from one of Google's reasoning models, Gemini 2.0 Flash Thinking Experimental. Distillation is the same approach Berkeley researchers used to create an AI reasoning model for around $450 last month. Now, S1 is based on a small off-the-shelf AI model from Alibaba-owned Chinese AI lab Qwen, which is available to download for free. To train S1, the researchers created a data set of just 1,000 carefully curated questions paired with answers to those questions, as well as the thinking process behind each answer from Google's Gemini 2.0 Flash Thinking Experimental. After training S1, which took less than 30 minutes using 16 H100 GPUs, S1 achieved strong performance on certain AI benchmarks, according to the researchers. Now, there's your $50 budget right there, guys. 30 minutes of 16 NVIDIA H100s. And it cost them $50 to rent them for that time. That is what it took to train this distill. Now, again, this is not this all-encompassing mass market product. This is just a tool that will do one specific thing. But compare this to the CapEx budgets we're seeing from big tech here, guys. Can you see how companies developing tools like this, specialized tools for single or double-digit dollars? I mean, the AI space is going to become so rapidly commoditized here. I just don't know how these hyperscalers are ever going to turn a profit, because this tool does not need a data center to run anymore. It doesn't even need an internet connection. It will now run on local hardware. So 30 minutes of 16 H100s, that's it. And now they're done with the data center. Nicholas Meninghoff, a Stanford researcher who worked on the project, told TechCrunch he could rent the necessary compute today for about $20. Oh, wait, what? For a minute ago there, he said that they trained it a month ago for $50 and that he can rent it today for $20. Yeah, you see those prices coming down? How's that CoreWeave IPO looking now, guys? Just wondering. Anybody out there? How's that $37 billion valuation thereafter? Not looking so good. All right, let's skip over to some labor data here. United States challenger job cuts. U.S. employers announced about 49,795 job cuts in January 2025. That is slightly higher than the 38,792 in December, but down 40% from a year earlier. So look, guys, we're just not seeing the pace of layoffs we would normally see this time of year. It looks like big tech is a little slow on the draw this year. They may be playing catch up. We haven't gotten the mass, 5-digit 20, 30, 40,000 people laid off headlines like we've gotten in 2024, 23, and 22. It just hasn't happened yet. Now, that being said, the pace of hiring is also slowing, but it's making it very difficult to figure out what this jobs report is going to look like this month. All right, so another reduction in layoffs versus a year ago. Now, we also got initial jobless claims here. Initial jobless claims increased slightly to 219,000 for the week ending February 1st. That's up slightly from 208,000 in the previous week. So a little bit of an increase in initial claims here, but you can see we're kind of settling into this lower level here. The pace of job losses is just way down from where it was mid last year. Now, on the continuing claims front, we got another increase here. Continuing jobless claims in the U.S. increased to 1,886,000 for the week ending January 25th. That's up from 1,850,000. So an increase of about 36,000 there. Continuing jobless claims aren't really coming down. They're staying stubbornly high. We've seen stories about how, maybe there's not a lot of job creation going on, not a lot of job losses going on, but the people who have lost their jobs are still having a very difficult time finding work. That story seems to be not really changing here. So we'll get more clarity on the jobs market tomorrow morning. We got non-farm payrolls coming out, and we will get into those numbers live tomorrow morning, just as soon as we have them. And I just want to say thank you so much to M&J for gifting those 10 Nobody Special Finance memberships. Thank you so much, M&J, for supporting the channel. I really appreciate everything you do. Also, thank you so much for your services as a channel moderator, keeping things neat and tidy in the chat. And once again, guys, I really apologize for my voice. This is 4 days now. Hey, man, I'm taking it easy during the day. It won't quit. My girls were coughing for about a week last week, and they brought it home from school, and now we all got it. So hopefully I'll be back with my typical level of energy and whatever you want to call it by next week. Uncle Fedster, thank you also for jumping that one there. He says, you're sounding better. Thanks for keeping the show going. No problem, brother. We do not miss shows here, not for nothing. All right. If I miss a show, it usually means something like my house is on fire or something like that. So no, we will. If I am physically capable, I will be here and we will keep the show going. Thank you very much, Uncle Fester, for the good vibes and for supporting the channel. And thank you, everybody, for having your coffee with the Melon Heads. Thank you for the support of the channel, M&J and Uncle Fester. Thank you also to my magnanimous Melon Heads on Patreon and YouTube. You guys are awesome. Link down below, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Don't forget that like button on the way out. Until next time, live small and dream big.